This is task 3 from AAT Sample Assessment 1 for personal tax. So for part A, we're told the information below relates to the investment income received during 24-25 by 2 taxpayers. So we need to complete the following statements, enter our answers in whole pounds, and if your answer is 0, enter 0. So Mr. Z received a dividend of £10,000. His other taxable income after personal allowances totaled £35,000. The tax payable by Mr. Z on these dividends is, and there are 2 marks available for this. So we need to remember that the way that the tax system works, remember we've got different types of income. So we'll have some general income, we'll have some savings income, we'll have some dividend income. And these are all taxed in a particular order and they all sort of stack up on top of each other. So if you imagine that we've got the sort of a graph. So yeah, there will be some sort of personal allowance. We'll have our income, but we'll deduct our personal allowance from that. And then we've got this other income then of the 35,000. So what we're going to do then, after we've deducted the personal allowances, we will then create this block of income for the 35,000. And what we need to do is see what is that in relation to the tax bands. And the first tax band is 37,700. So that means that all of that income is going to be in the basic rate band. Now remember, we're only focusing on what's the tax on the dividend, so we're not really interested in that. But what we can see though is that there's still some of the basic rate band available. So then if there were any savings income, we would then recognise the savings income on top of that. Remember, we're stacking all these different types of income, but there is no savings income in this case, so we don't have to worry about that. Okay? But if there were, we'd have some savings income and see what impact that had where it met the various bands. And then we'd have our dividend income, which we would then stack on top of that to work out what bands that affected. But in this case, though, we don't have any savings income. So what we're going to do then is we take our 10,000 dividend income and we just stack that on top of the other income. But notice that some of that is in the basic rate band, but some of it now goes into the higher rate band. So of that £10,000, we need to recognise that some of it is covered by the dividend allowance. So let's go and have a look at the reference materials to remind ourselves what that is. So we're looking at section 2 of the reference materials, and there is a dividend allowance of £500. So of that £10,000, we need to recognise that 500 of it is part of the dividend allowance, and we will pay no tax on that at all. And that's 500 of the spare 2,700 that's still in the basic rate band. So to get up to the basic rate band, there's a further 2,200, and we're going to pay the basic rate on that. And then above that, there's a further 7,300 to give us the full 10,000. And that's now gone into the higher rate band. So we need to remember that the 500 allowance does consume some of the basic rate band. So yeah, 2,200 brings us up to the basic rate band, and then there's 7,300 above that. But we need to know now what are the rates that we should be using, and this is also in the reference materials. So we're looking at section 1, and we can see that in the basic rate it's 8.75%, and the higher rate is 33.75%. So we're going to multiply the 2,200 by 8.75%. which gives us tax due of £192.50, and then we multiply the 7,300 by the higher rate of 33.75%, which gives us £2,463 and 75 pence. So collectively that gives us 2,657. Let's look at Miss Y now. So Miss Y received 2,500 in interest from her building society account and 240 in interest from her individual savings account. So remember that the individual savings account is a government account, and the government wants to encourage people to lend it money, and therefore interest that the government pays on ISAs are tax-free. So we don't have to worry about that 240. We're also told her other taxable income after personal allowances totaled 66,750. And that's important because that tells us that it's above the 37,700, so this is a higher rate taxpayer. So we need to find out what is Miss Y's income from investment on which the tax will be paid. So let's show you this graphically as we did before. So we've got now income of 66,750 after the personal allowance, remember. So that uses all of the basic rate band of 37,700. And then on top of that, we've got our savings income of the 2,500. That's all going to be at the higher rate. But looking at our reference materials for savings, the higher rate taxpayer has an allowance of £500. So of that 2,500, 500 is tax-free. So 500 of this is going to be at zero tax, and the remaining 2,000 will be taxed at the higher rate, which is 40%. So the income from the investment, which is subject to tax, is 2,000, and the tax payable, well, 40% of 2,000 is 800. For part B, we're looking at property income now. So Mrs. J owns and rents out 2 properties during the 24-25 tax year. Relevant information on properties is shown in the table below. So we need to complete the table below to show taxable rent and allowable expenses for these properties in the 24-25 tax year. And then as usual, enter our answer in whole pounds only. We shouldn't use any brackets or minus signs. Yeah, so for the expenses, we don't put any minus signs there. Remember, if you don't follow the instructions, then the computer-based exam software simply won't recognise your answer as being correct. And if we think the answer is 0, we should enter the number 0. So for the first one then, Sunny Street was let from the 1st of June 2024 for the remainder of the tax year for £1,250 per month. Rent is paid on the 1st of every month. Now that's significant because for property income, we do this on the cash basis. So our tax year finishes on the 5th of April, doesn't it? But that means that one of the rents would have been received on the 1st of April. So we just need to count how many months are relevant for this then. So again, just counting on our fingers, we've got June, July, August, September, October, November, December, January, February, March, April. So that means we have 11 months. So our taxable rent is going to be the 11 months multiplied by the 1,250 we get per month, and that's going to be 13,750. Now we're told that they pay 8% commission to the letting agent, so the allowable expense is going to be the 13,750 multiplied by the 8% that we pay to the agent, and that's 1,100. And then for Cloudy Close was let from the 15th of January 2025 for the remainder of the tax year. So again, counting on our fingers, that's going to be January, February, March. So that's going to be 3 months, and we pay 420 per month. Again, we're told the rent is paid on the 16th of every month, so yeah, that's 3 months. So that means our income is 1,260. And we're also told that Mr. J paid 210 to repair the roof, so the word repair is significant because if it were a capital item, then that wouldn't be an expense. But repairing is okay. So repairing the roof and chimney, so that's going to be a full 2,100 as an allowable expense. And then part C, identify whether the following statements are true or false. So the first one, an additional rate taxpayer will pay tax on dividends at 45%. Well, here's section 1 of the reference materials, and the question said it was an additional rate taxpayer, and it was about dividends. So we can see there the tax rate is 39.35%. So the answer to that is false. And then a landlord replaces a broken washing machine with a new one. The same model of washing machine as the broken one would have cost 700, but the landlord decided on an improved model which cost 900. The landlord can claim 900 as an allowable expense. Well, the issue we have here is because they are replacing it with an improved model, then that's not okay. So the extra £200 would be a capital expense because that's an improvement. So they can only claim 700 as the allowable expense. So in this case, this answer would be false as well. And we're only allowed to claim like-for-like replacements. But remember that there is a bit of an exception to this. We're allowed to take into account how things have changed over time, and the typical one they've done in the exam is where we replace single glazed windows with double glazed windows. Because double glazing is the standard today, then replacing single glaze with double glaze would not be considered an improvement. But in this case, yeah, it tells us in the question that it is an improved model, so that means that the £200 would be a capital expense, not an allowable revenue expense.